So I've been dividend investing for the last 4.5 years or so, which in the grand scheme of things is not a super long time, but still in this relatively short period, I've learned a few tough lessons, and I want to share those with you today, starting with this first one here. Now, don't get me wrong, there are a lot of great dividend aristocrats and dividend kings out there, and an extensive dividend growth history is certainly something you'd like to see in an investment. You know, you want to invest in companies who've proven they can actually grow their dividend. Having said that, though, I think a lot of investors, especially new investors, make the mistake of thinking that just because these dividend aristocrats and kings have these extensive growth histories that they're like invincible and that they're like the best dividend stocks out there, when in reality, that's not always the case. And at least for me, I had to learn this lesson the hard way by investing in 3M. This was one of the first dividend stocks I ever bought, and I remember at the time thinking, you know, this is a huge company. It's one of the biggest companies in the world. Their products can be found in pretty much every industry, so they're very well diversified. Plus, they're a dividend king with over 60 years of dividend growth. So, like, what could go wrong? This was pretty much the extent of my research at the time, and what I didn't realize was that 3M is actually a pretty stagnant business, and their revenue and profits really haven't grown at all over the last decade, which at a certain point was going to be problematic for the dividend. And meanwhile, they were in the middle of some pretty serious litigation that ended up being a huge drag on the company. Long story short, if we take a look at my dividend portfolio tracking spreadsheet, which you can start using for free, there is a link to download this spreadsheet in the description of the video. But looking at this, we can see that I ended up seeing a pretty big loss on 3M before I finally decided to cut my losses. Looking at the share price returns, I was down almost 33%. On a total return basis, I ended up selling for a 27% loss, including dividends, and the share price today is even lower than when I sold my position almost a year ago. And with this, a few months ago, 3M did finally cut their dividend, which in the grand scheme of things is definitely a necessary move for them, but still goes to show that even the most royal dividend kings can fall on hard times. And 3M actually isn't the only dividend king to have recently cut their dividend. Last year, we saw VF Corporation, ticker symbol VFC, cut their dividend not once, but twice, which is every dividend investor's nightmare. And another king, Leggett & Platt, ticker symbol LEG, cut their dividend earlier this year to the tune of about 90%. Now, from a long-term perspective, cutting the dividend is a necessary move for these companies, no doubt about that. But for investors, the takeaway here is that more due diligence is required than just looking at a company's dividend growth history, and more due diligence is required than seeing something as a dividend aristocrat or a dividend king and then considering it a suitable investment just based off that. You need to look under the hood in the financials to make sure that the company is growing and that the company can actually afford to continue paying and growing their dividend. So in the same way that you shouldn't buy a stock just because it's a dividend aristocrat or a dividend king, you also shouldn't buy a stock just because it has a high dividend yield. Now, we've talked about this like probably to death here on the channel, but I think it's an important idea to revisit every so often because there's something about how we're wired as humans that makes us dividend investors gravitate toward the highest possible yielding investments we can find. It's one of those things about human nature that just doesn't change, and so we as investors need, I think, a frequent reminder to not chase yield. Now, don't get me wrong, there are some really great high yielding stocks out there, a few of which I think I have in my own portfolio, but at the same time, there are some really bad high yielders out there, but fortunately, there's a pretty easy way to spot them. Now, jumping over here to Seeking Alpha, we'll take a look at an example of what I think is a pretty bad high yielding stock. This is also a very popular one. This is Orchid Island Capital, ticker symbol ORC. And if we scroll down, taking a look at the dividend stats, we can see that ORC certainly has a high dividend yield coming in there at 17.4%, which at first glance is definitely very enticing. That is undeniably a juicy dividend yield, and it'd be easy to get reeled in just by looking at that high yield. But like I said a moment ago, it's very easy to tell whether or not you're looking at a good high yielding stock or a bad high yielding stock, and the way to do so is by looking at the 5-year dividend growth rate, which for ORC, we can see is negative 20.3%, which means that over time, Orchid Island Capital has decreased their dividend payments over the last 5 years by an average rate of 20.3%. That's pretty substantial, and that's the opposite of what you want to see. You want to invest in a company that's able to grow their dividend payments over time, but this one right here is decreasing their dividend payments over time, which means that, yes, even though you're getting a high starting yield at 17.4%, your cash flow return is actually going down over time because your dividend payments per share are going down over time. And looking at ORC's dividend history, we can see that they are a notorious dividend cutter. I mean, over the last 10 years, there has been numerous occasions where this company company has decreased the dividend payments per share. So once again, this is the exact opposite of what you want to see. And ORC is not the only high yielding stock like this. I mean, I have a running list over here on Seeking Alpha of certified yield traps. And as we can see, all of these companies have negative 5-year dividend growth rates, which means that all of these companies are decreasing their dividend payments per share over time. So as a general rule of thumb, I'd avoid any company that has a negative 5-year dividend growth rate, and therefore I would probably avoid all of these companies, unfortunately. It's a great thing to be able to buy stocks below your cost basis because you're getting those shares for cheaper, meaning that you're able to buy more shares with the same amount of money, which is great. But in addition to that, you're also able to lock in a higher cash flow return because as the share price goes down, the dividend yield goes up. Still, there's a reason why a stock's share price goes down. And your job as an investor is to figure out what that reason is. Sometimes it's nothing, and then buying the dip can make sense and can actually be a good thing. But other times the share price could be going down because of legitimate underlying issues within the company. Going back over here to Seeking Alpha, I think we can look at a company like Walgreens Boots Alliance, ticker symbol WBA, as a good example of this. I mean, if we look at the share price performance over the last 10 years, so a long period of time, this company is down about 85%, and it's been a pretty steady decline. I mean, certainly more aggressive in recent years, but over this time period, the decline in the share price has been pretty steady for Walgreens. And if we jump over to Walgreens' income statement and just look over the last 10 years, I think it makes sense to see this company's share price declining. I mean, one of the biggest things we'll notice here is declining margins over the last 10 years. Looking at the gross profit margin, it's gone from about 28% down to now about 18.4%. And it's been a pretty steady decline over the years as well. So that's not a great sign. And we can see a similar trend here in the operating margin. It's gone from about 5% 10 years ago to now just above 1%, which is not great. And then if we continue to scroll down, looking at the net income margin, so the bottom line, we can see a similar trend here as well. In fact, at this point, it's even dropped into the negative territory. So now Walgreens is at a point where its margins have declined so much that it's actually losing money. And looking at the earnings per share, just in the last year, it was minus $3.57. So in this instance, even though the share price has really gotten a lot cheaper over the years, and you might look at that and think, I need to buy the dip on that, you know, this does appear to be a business in decline. And outside of what we looked at with the income statement, there's been some other things going on with Walgreens. Like they recently reduced their dividend by a pretty substantial amount. I know they're now closing a ton of stores, so not very great for Walgreens. And overall, this is a dip that I would personally not want to buy. If you're early on in your investing journey, sometimes it can feel like drinking from a fire hose of information. You're probably watching a lot of YouTube videos, reading a ton of articles, and just taking in everything that you can, which is great. You want to soak it all up and learn as much as you can. But with that said, you shouldn't just listen to us talking heads here on the internet and take that at face value. You most definitely shouldn't be investing in a stock just because Ryne is investing in it, or because Russ is investing in it, or because the Dividend diplomats are doing it, or whoever else. All the different people that you watch and listen to here on the internet are good places to go to get ideas, and it's certainly fun and inspiring to see everyone's portfolios and see what they're doing. But there have been, and there will definitely be, more times where I'll be wrong and I will lose money, and that's going to be the case for every other investor that you follow. And so because of that, you shouldn't be doing things just because somebody else is doing them. If you're going to invest in a company, you need to do it because you think it's a good investment and because you understand your reason for why that is. In my personal life, I really don't know anyone else who's interested in investing, and most definitely don't know anyone else who's interested in dividend investing. I think a lot of us here in the community are like that. You know, it's a pretty lonely hobby. And then when you try to talk to your non-investing friends about it, they just look at you like you're from another planet. But you need to realize there are tens of thousands, if not millions, of people out there just like you who daydream about dividend growth CAGRs and return on invested capital, and you never know when you're going to run into one. But the only way to find out is by talking about it. Also, you never know who you're going to be able to introduce to investing just by speaking up about your experience with it. You know, word of mouth can be pretty powerful. And so I think that whenever you have the opportunity to do so, you should talk about what you do with investing. As you know, getting into this can be a pretty life-changing thing. So you never know who you're going to be able to help just by sharing your experience. You'll often hear dividend stocks like Procter & Gamble or Pepsi or Coca-Cola talked about as being these sleep well at night stocks, which essentially means that you don't really have to worry about them. They're ones that you can sleep well at night holding on to. And while that's true, that's also not to say that you should necessarily just buy and forget about these stocks completely. You know, businesses, no matter what they are living, breathing entities that are constantly changing and are constantly fighting for survival. So you need to keep tabs on what's going on with them, or else you might miss something important. Now, with that said, a lot of the daily news that does come out is just noise, and most of it's not really life-threatening stuff, but still you need to be aware of what's going on with the stocks in your portfolio. And over time, you'll be able to gauge what's noise, you know, and what's actually worth paying attention to. Long story short, if you're going to own individual companies, then you need to stay involved with what's going on with them. And if that's not something that you want to do, you know, if you're looking for something that's more hands-off, then ETFs might be the better way to go. You know, like we talked about earlier in the video, it's human nature to want things to happen as fast as possible. But with this, and when it comes to really anything worth having, there are no shortcuts to getting it. You know, in other words, you can't skip to the end. One thing you'll learn though, as you go through this, is that even though living off dividends is gonna be a whole lot of fun and you're excited to get there, there's also a lot of fun in the getting there. You know, there is so much to learn along the way, and at least in my opinion, that's one of the things that makes all of this worthwhile. And people ask me all the time, like, why would you buy individual stocks when you can just buy ETFs and not have to deal with it and not have to think about it? But the thing is, I like thinking about it. Spending time learning about investing and researching stocks has taught me about a wide variety of subjects like accounting, economics, psychology, philosophy, history, statistics, and so much more. Granted, it does take a long time, but this stuff is fun for me and it's totally worth doing. You know, there's been a lot of personal development that has come out of researching stocks and learning how to do all of this stuff, and the things that I've learned these last handful of years I probably would not have if I would have just stuck to ETFs. And also in this time period I've made more passive income than I ever thought I would, which is what I'm telling you about in this next video right over here. In this one I'm sharing exactly how much money I've made with dividend investing these last 4 years, and we'll also take a look into the future to see how my dividend income will continue to grow over these next couple of decades. So click right over here to check all of that out, and I'll see you in the next one.